I'll start with this today. Some of you submitted questions in advance, and I'm going to answer those questions. I saw that there were some questions about certain stocks, some interesting stocks, NIO, NEO, not NIO, NEO, XLY, and ETF, EATZ, STAG. I see some of you asked questions about these things. I saw a brother that asked a question about the yield curve. John Green did. And William Lumpkin asked the question as well. So what I'm going to do is I'm going to sort of give you an overview of where the stock market is right now. And then what I'll do is I'll answer some of your questions. So generally speaking, today the stock market did well. It's pretty, what you're getting right now is what they call the Santa Claus rally, where basically because there's low trading volume in the stock market, you see sometimes, typically, historically, you see a little bit of a bump in stock prices toward the end of the year. And this is something that doesn't happen with complete certainty, but it is something that's happening now. I'm not sure where the S&P 500 is exactly, but I know the Dow went up. The S&P gained 0.3%. It's hit 4,800. Which this guy named Tom Lee from Fundstrat, who's been predicting the S&P 500 was going to end strong for the year. So it looks like Tom Lee was correct. Good for him. And the Dow hit a new record high. So now the Dow is sitting at, let me see here. Let me actually pull this up on my screen here. Dow, DJIA. I'm not just going to pull up on my screen. I'm going to actually show a graph. For those of you that are in the Zoom, you can actually see the graph. Okay, so the Dow, or you'll see the graph in 1 second. Sorry, give me 1 second. Let me share the screen a little bit because I want to kind of give you some context on what happens when you are a patient investor. So if you look at the Dow, it's now at 36,465. Now, because a lot of us, sometimes we get trapped in the moment, we don't understand the significance of that. Well, if you look back at the Dow, if you go back to when the pandemic began, March 20th, 2020, that's kind of the official start date of the stock market crash that occurred during the pandemic. You see where the Dow was at 19,173. So literally you've had almost a doubling of the Dow since the start of the pandemic. Right. And if you go back and you hear the things I was talking about, we were doing this class every week, even back at the start, before the start of the pandemic. And in that week, it was kind of a crazy week, a crisis week for the market. And one of the things we consistently talked about is, I said, look, I don't know how this thing's going to play out. Nobody knew exactly how the pandemic was going to play out. For all we knew, this could be another Great Depression. But I said, it's whenever you see quality companies that are suddenly at that deep of a discount, where you got companies like Walmart and Disney and Microsoft trading at a rate that's 30% lower than where they were just a week ago, you have to question that. You have to say, okay, maybe this is my big break. Maybe this is my big opportunity to have a come up, right? These secret little opportunities, I almost want to call them financial wormholes. Like you think about wormholes on Star Trek. What is a wormhole? A wormhole is where you have a sudden opportunity to go from point A to point B very quickly, right? It's where time, space kind of bends, and you're just for a very limited time able to go back in time and definitely travel long distances in space. And to me, I think about wormholes actually in two ways that apply to real life. One is I think about wormholes in relationships. Like a relationship wormhole is where you're in love with somebody, they're in love with you. I can walk up and touch my wife's butt and it's not a big deal. She doesn't think it's strange or anything. But if our relationship fell apart and she was in love with someone else, then if I touched her butt, I would go to jail, right? That would be a crime, right? So why do I bring up that weird example? Well, because I think of it like a wormhole, because, in that moment, you have that moment. And if you let that go, then that wormhole may shut, that opportunity may shut, that window of possibility shuts on you, and it doesn't open up anymore. If you ever watch episodes of Star Trek, you know what happens when the wormhole closes, right? So to me, when the market was down at 19,000, that to me was an economic wormhole. That was an opportunity for you to just get in where you fit in and have a major come up where you literally jump tax brackets. You jump from poor to middle class. Or you jump from middle class to wealthy, or you jump from rich to super rich, or also cryptocurrency. When Bitcoin was trading for $50, $50. A person who went ahead and made an investment, a heavy investment in Bitcoin, let's say you just had an extra, $2,000 or an extra $1,000 or whatever, and you dropped $1,000 in Bitcoin, when it was $50, and you forgot about it. Let's say you had the pay. That's the other key idea. That's really important in investing. A lot of people don't have this, is patience, to kind of let the seed grow, to let things kind of play out, right? So if you had, let's say, dropped, $1,000 in Bitcoin, back in, when it was $50, which wasn't that long ago, then you would literally right now have 20 Bitcoin. Well, 20 Bitcoin right now, I think, is worth about $1 million, right? Literally $1 million. I think it's $1 million. So ultimately, what I would say to you is these wormholes always open up. And what happens is that when the wormholes open up, most people don't even see them. Most people don't even notice them. Experts like me, at best, we're able to identify what looks like it could be a wormhole. Do you follow what I'm saying? Right? So you have these financial wormholes that give you this instant opportunity for a come up, right? People like me, because I have a PhD and because I've seen what wormholes look like, you can only identify financial wormholes clearly after the fact. Right? In economics, the term we use is the terminology is ex ante versus ex post. Ex ante is before the fact, right? Before the fact, anything can happen, anything is possible. You don't know what it is, right? Like you're dating a girl, you don't know what the future's gonna happen, or what the future's gonna look like. You don't know if this is the last time you'll ever speak to her again. You don't know if this is the your one chance to go on a date with her, but and you're missing it. You don't even know these things, right? But but the thing is that an older person who can see who's seen a lot of things ex post, who's seen a lot of data, right? Data is important for us as scientists, right? Who's seen a lot of data, ex post data. We're not 100% precise, but that OG, that older person, is the person who can help you understand when you might be facing a wormhole. So imagine an older person. Let's say, for example, let's say you've been dating your girlfriend for 4 years and you get in a big fight and you're like, oh man, forget her. I don't need her. I'm going to just go on with my life, right? Well, an older person might come up and say, look, young brother, let me just tell you what happened to me back in 1974. I was in love with Cynthia and blah, 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 blah. And one day I got mad about such and such. And next thing you know, she was gone and I've regretted it my whole life. Right. So what he might be saying to you is that this could be a wormhole, and this wormhole, once it shuts, you can't go back. You can't go back. So with the pandemic, what looked like a crisis to a lot of the world, for people like me, it looked like it could be a financial wormhole. This looked like the one chance you had to get in while the market was super low. The Dow was at 19,000. Now, here we are 2 years after the pandemic, almost 2 years, about a year and 9 months. And now you've seen it play out. Now you've seen the wormhole from behind. It's now 100% abundantly clear. So the question that you must ask yourself now as an investor, and this is why economic intelligence and financial literacy and all these things we discuss are so important. The question you must ask yourself now is, where are the wormholes for the future? What amazing opportunities are opening up right in front of me right now that I am going to clearly see 5 years down the line, but I cannot see them right now? Is it crypto? Maybe Bitcoin, is one day going to be worth $300,000, and you're going to look back and say, man, I should have bought it when it was 50. Maybe it's some small cryptocurrency. Maybe it's Engine Coin. Oh wow, Engine Coin. Remember when Engine Coin was $1.80? Oh man, I can't imagine that now, because now it's $1,000 a coin, right? Maybe it's some of these metaverse ETFs, right? I mentioned to you guys last week. Actually, if you go log in at the blackstockmarketprogram.com, you will see that under what Dr. Boyce is buying, I put some new stocks that look like they could be financial wormholes. One of them is a metaverse ETF. The ticker symbol is Meta. And I think that $15 per share one day in 5-10 years could be cheap. It could be a low price, right? So there are financial wormholes emerging around you all the time. You want to become literate enough to know where they might be. You also want to consult with experts who have seen lots of data so they can identify to you and for you where these wormholes might be. So just in terms of telling you what's happening in the market right now, you're very lucky. You have the Santa Claus rally. This omicron variant is not slowing down the stock market at all. Basically, a lot of the travel stocks that we talked about last week, where I told you that the airlines and the cruise ships are all cheap. Well, now those prices have gone back up again. So if you bought some of those stocks we talked about last week, you probably made some money. They said also many Wall Street pros predict relatively small gains in 2022 after 2 strong years. Quote, if you look around Wall Street, you see very tame expectations, and it's probably a reflection that we're pretty late in the cycle. So basically what they're saying is that the wormhole is kind of closed. Your big come up, your big opportunity market wide has kind of disappeared. But here's the thing. There's always an opportunity somewhere. There are always little wormholes somewhere. So scouring for research and data and information from reliable sources can help you identify where the next wormhole might be. So they said for the year, the S&P 500 is up more than 27%. The NASDAQ is up 23%. Now, that is a little bit surprising because typically the NASDAQ outperforms the S&P. This is one of the few years where that has occurred. And a lot of it's because your tech stocks are getting hammered a little bit. And they're going to probably continue to get hammered in 2022. It doesn't mean that they're all garbage, but it does mean that basically a lot of these tech stocks, what they are is they are what they call long duration stocks, which means that a lot of them haven't even made any money yet. They're newborn babies as far as companies go, and people are investing heavily in these newborn babies. But unfortunately, some of these babies aren't going to make it, and so now the market is sort of leaning back toward those strong, stable companies that are generating consistent revenue with good management structure. So let me answer some of your questions real quick. Let me back down. Just so you know, if you have a question you want to ask me, you can log in at theblackstockmarketprogram.com. You can leave the question for me. I'll answer it next week. I'll answer these questions first. Also, the other thing, too, is if you have a question about a particular stock, try to put 2 stocks in there so I can sort of look at those 2. Don't put like 8 different companies or a bunch of ticker symbols. Just maybe 2 is enough. And then if you have 2, more, you can just put 2 more for the following week, and we can kind of do it that way. That makes it a little bit easier so I can answer everybody's question. Okay, Regina says, what are some good bonds to invest in? What I would probably look for, Regina, are some bond funds or bond ETFs. I'm not a big believer necessarily in buying bonds per se. I think that you can just buy a bond fund, which will give you the same exposure, same opportunity. The difference is that all you have to do is pay your money, and the experts kind of handle the rest. They look at the bond, they analyze the risk, they assess all those things, and you're just sort of leaning toward the experts. So if you go into your Robinhood app and you look up bond funds from Vanguard and other companies, you could probably find some good bond funds that way. Let's see here. Helen says, Dr. Boyce, what is your take on the bank's intended cash squeeze? Okay, I don't know much about that. Let me, if it's something in terms of like an economic conspiracy, I'll just tell you, I kind of think you want to be careful about jumping into conspiracies. But what they're saying here is the cash squeeze is a shortage of money or funding. So let's see here. I'm trying to see if there is anything in the news. Okay. If you're referring to a lack of access to capital, that's going to result as, because the Fed is now changing their policy, that can happen, right? That can happen where the banks are not letting money go as easily as they did before. When the Fed wants to slow down the economy, one thing that they do is they might raise interest rates. And when they raise interest rates, you end up, sort of having a scenario where it's more difficult for companies to borrow money from banks. Banks basically they charge a higher rate. An interest rate, you can think of an interest rate like the cost of renting a car, right? If I charge you, $50 a week to rent a car, then I'm going to run out of cars. Everybody's going to want to rent a car. But if I increase that number to say $500 a week, then fewer cars will be rented. So interest rates, the same way you rent a car, an interest rate is basically you're renting money. So what the Fed is doing is they're saying we're going to increase the cost of renting money, and also by reducing bond purchases and all that, we're going to reduce the supply of money that's even available to be rented in the first place, right? So imagine you have a place where they're building construction everywhere and they're charging really cheap rent, where you're going to have a ton of tenants moving into that complex. But let's say that they put a limit on the amount of construction they can do, and they increase the rent. Well, that's going to make it more difficult for people to move in. So you're not going to have as much demand as you did before. In fact, that's one of the reasons why you have the homelessness problem or the housing crises in really expensive cities like Austin or cities where there's a lot of tech companies. The Bay Area has a housing problem, and some other areas. It's not just because the housing prices go up, but the housing prices are going up partly because one, there's a lot of tech companies there, and the tech people have all the money. That's why I've mentioned to you all, get your kids into tech and entrepreneurship. If you want your sons and daughters to be wealthy, and they have an interest in technology, don't just send them to college where they can get a degree in engineering and go work for a company. Tell them to also take a minor or major in entrepreneurship, so they can learn how to take their tech skills and create a scalable business that will allow them to have some ownership in a company that has the potential and capacity to grow, to create their own financial wormhole. That's where the Elon Musks come from. That's what our son is doing right now in college. He's an engineering major. He talks about looking for jobs, and I don't stop him. But then I say, the big money is over here in case you're ever ready. So maybe when he's 26, 27 years old, he'll look over and say, okay, I had the job experience. Now I want to actually own the job. I want to own the company. I want to actually have the money that I want to go buy me that $100,000 car or whatever he's trying to do, right? So ultimately, a lot of the tech companies have all the money. So when these tech companies plant themselves in cities like Austin and the Bay Area, the price of rent goes up because there's more cash chasing a limited number of opportunities. But what makes it even worse is that if you analyze the building codes or whatever they call it, how they zone the city, they put limitations on the amount of construction that can actually go up. So a lot of the people that say that they want there to be low cost housing and all that, they don't support it when they go to those cities and they go to those communities and they say, we want to build a complex that can accommodate, 10,000 more people or 3,000 more people or whatever. They say, we don't want that in our neighborhood. So they put limitations on the amount of building that can be done, which limits the amount of constructions available. So the same thing with economy wide, sort of the way money's looked at is if there's a limited amount of money out there, and then they increase the rent on that money, the cost of actually obtaining that money and borrowing that money, then that's going to slow the economy down, because what happens is that investments don't look as good when the cost of renting the money to make the investment is super, super high. All right, so let me keep going. All right, so let's see. Next question submitted is so by the way, Helen, that does mean that there is a cash squeeze that's going to occur with the banks, largely because of the increases in interest rates. Long story short. Let's see, William, I have a TD Ameritrade account. I'm taking advantage of your classes and information offered in the course Black Money 102. Okay, great. I'm glad to hear that. I have read ETFs are a better investment as far as tax laws over mutual funds. Are you familiar with any tax advantage one has over the other, particularly for me being retired? Well, first of all, as far as tax questions go, I would talk to a tax professional, just to be clear, because I'm not a tax expert. We have tax experts in the Black Business School. I'm not one of them. In fact, actually, Rebecca Samuels is coming to visit, and I'm gonna have her come into the Black Wealth Bootcamp to talk about crypto and crypto taxes. A lot of people are going to get hammered pretty bad because they've acquired all this crypto, and they thought that was under the government's radar. Now the government's going after crypto to tax more. The way the Biden administration is paying for all these spending plans, they say that they're going to make the money by taxing rich people over the next 10 years. That's not going to occur, because rich people, they fight back when they try to raise taxes. They send the lobbyists and all this other stuff. So they're too tough of a target. So the easier target is the middle class and the working class. So one of the things that they're doing is, this is a little known part of this spending bill, is they're increasing the number of IRS agents, I think, by another 70, 80,000 agents whose job is to specifically go out and dig up all the places where you're not paying your taxes. So basically, when it comes to things like crypto, you got to make sure you pay your taxes. Make sure you're good with that. Keep that in mind. If you log in at the blackstockmarketprogram.com, I'll try to make sure all of you guys get an invitation actually to hear Rebecca Samuels when she comes in and she talks. Also, by the way, the Black Wealth Bootcamp starts January 6th. So if you'd like to join, you can actually get a 48% discount if you go to boycewatkins.com. There's a link at the top. And for that link, which is there for another day or so, you can actually get 48% off the bootcamp. So feel free to take a look at that. It's boycewatkins.com. So with that said, William, I would say that ETFs, I'm not aware of any specific tax advantages of ETFs. I will say, though, that when you talk about tax deferred accounts, IRAs and 401ks and Roth IRAs versus traditional, et cetera. That's where you get a lot of tax advantages. A SEP IRA, self-directed, is something that you get if you're self-employed. And so ultimately, that's where I see most of the tax advantages. I don't know of any other advantages that ETFs might have over, say, regular mutual funds. Okay, so but you definitely want to take advantage of all your tax deferred options that might be out there. Yeah. Oh, the Black Stock Market Bootcamp. No, it's the Black Wealth Bootcamp. The Black Wealth Bootcamp. I would send you to the blackwealthbootcamp.com, but don't go there. If you want to sign up for the bootcamp, I want you to get the discount. You can feel free to go to boycewatkins.com. There's a link right at the top, and it gives you a 48% discount on the Black Wealth Bootcamp. That code expires in 24 hours, but you can feel free to go to boycewatkins.com. It's right at the top, and the bootcamp starts January 6th. It's a lifetime membership. Also, what I did was I put all the recordings of the previous bootcamp, which has incredibly powerful breakdowns and information on all the different ways to make money, all the different ways to reduce your dependence on the corporate plantation. So it's a great program for people who either want to quit their job or just quit their job and are trying to find ways to make more money, or maybe they haven't had a job in a while, but they don't want to ever be in a situation where they're struggling with financial security. The Black Wealth Bootcamp is probably our most popular program. We start January 6th. I only do one bootcamp per year live. But what I did was I took the last boot camp and the recordings of all that, and it's already there. So if you log in right now, you can actually get started right now and go through everything we did last year. But every year is different. So this year, I'm going to do it live starting January 6th. We're going to meet 8 p.m. on Thursdays. So you can get a 48% discount. The regular price of the boot camp is $5.99. So for the next 24 hours, or well, actually until the code expires, which is about 24 hours from now, you can actually get 48% off, which drops your price to $311, and that's for a lifetime access, right? So that's a lifetime membership. It's not monthly, annual, none of that. One-time fee. Bring your whole family. It's really fun. You're gonna love it, and there's a money-back guarantee. So feel free to go take a look. All right. So and that's boycewatkins.com. That's where you can go take a look at the bootcamp. All right. So the let's see. John Green says, my son John met you at the gym yesterday. I remember John. Yeah, I was playing basketball. I'm so bad at basketball. I've gotten fat and tired, and I was playing with the kids. But I do remember your son. He's a very nice young man. He says, as he shared with you, your efforts in education has been a game changer for us. Yeah, he mentioned that your family is actually implementing the things that we've been talking about. And that made me super proud of him. And I'm super proud of you, because I could tell that your son was thinking differently economically than a lot of young people, even myself. I know I have a PhD in finance, but I didn't come from a culture that really sort of talked about investing and entrepreneurship and all that. At that point in my life, the age that your son was, I guess your son was early 20s or so. At that stage in my life, I thought investing was for white people. It was really like, studying investing in stocks and finance was like, it's like becoming an expert on elves and fairy tales and Lord of the Rings. Like it literally was like a fantasy world where I was like, well, if I learn this stuff in theory, then one day I can get a job talking about all this investing. I didn't actually think of it as something that I was supposed to do, because I didn't know anybody who was doing it in real life. It took time for me to get to that point. Right. So your son was already doing it in real life. And I could tell that education did not come from a high school. It didn't come from a university. It came from his parents. And that's what I'm just really telling everybody. The parents, that is your child's school system. That is where the education occurs, right? So congratulations to your family. It was really great to meet your son. And he says, let's see, totally appreciate the video. Shout out, man. Absolutely, it was my pleasure. He says, okay, conversations about flattening of the yield curve. Is this a reference to Fed interest rates or bond market behavior? Fed interest rates or bond market behavior. Fed interest rates or bond market behavior. I'm saying that 3 times because I want to process what you just asked me. All right, so so just to answer that question, some of you are not aware of things like the yield curve. Now, if you log in at the blackstockmarketprogram.com, I have some deep lectures where I break down the Federal Reserve and what they do and how they operate and the board of governors and everything else. So feel free to go take a look at that if you want to, or you can email our support team. They can help you find the lectures. I know there's a lot of material in there. But basically the yield curve, what that basically is reflecting is the fact that when you talk about bonds, buying bonds, every bond has a yield, right? And the yield is the rate of return I'm expected to receive by holding that bond to maturity, right? So that is very different from what they call the coupon rate, right? The coupon rate is the amount of interest that the company agreed to pay for that bond, right? So the company issues a bond. It's $1,000 bond. They say we're going to pay 5% interest for anybody who holds the bond. That means if you buy the $1,000 bond, you're going to get about $50 a year in interest because you loan the company your money, right? Well, what happens though is that once the bond gets traded on the public market, the bond price goes up and down. It goes up and down based on various market conditions. That creates the yield. So if there's $1,000 bond that pays $50 a year in interest, that yield is 5%. But if that bond price drops to $800, let's say, so somebody could buy the bond from me for $800, well, then the yield has gone up, right? Because when an $800 bond pays $50 a year, that's not 5% per year in yield. That's maybe 10% or 7% or something. It's a higher percentage rate, right? So yields go up. They tend to go up. The yield curve tends to slope upward, meaning that longer bonds, like bonds that you hold for longer periods of time, tend to have a higher yield. That's what they mean when they talk about the steepening of the yield curve, that the longer you loan your money to the government, and this is particularly treasury bonds, right, and treasury notes, but the longer the term, the longer the amount of money you loan to you loan your wealth to the government, the higher of a yield you expect to receive, the higher ROI you expect to receive. And that makes sense, right? Because you're locking your money up for a longer period of time. Like if I let you borrow my car for a day, that's very different from me letting you borrow my car for a year. If I let you borrow my car for a year and I got to go a year without my car, then I'm going to charge you a whole lot more than I would if you only need my car for a day or for an hour or for a week, right? So a long story short, what happens is that when the yield curve is really steep, it kind of means that everybody expects the economy to be strong. They expect, that the Fed isn't going to increase interest rate, or maybe the Fed might increase interest rates a little bit, but not much. That everything's going to kind of hum along. Typically, what they call a flattening yield curve is when short-term yields kind of go up. And that's mainly because they expect economic problems. So basically, the flattening of the yield curve, which I think is what's happening right now, is kind of an indicator that we're expecting that while the economy might be strong, the Fed may be in a position where they have to make some decisions based on uncertainty, a lot of economic uncertainty. So when you ask that question, does the flattening of the yield curve link to, I think you said bond market behavior or the behavior of the Fed? It's really both. It's really both, because what's occurring with the yield curve and with the bond market and with the stock market is that you're having a two-person tango. You have the Fed, what the Fed does, and then you have the market's reaction to what the Fed does. And the market's reaction to what the Fed does isn't just based on what they did. It's also based on what they think they're going to do next. It's based on what implications they think that the actions are going to have. It's based on expectations and what they think the market's going to do. And the things that kind of drive stock prices, generally speaking, two major factors are corporate earnings, what they expect companies to earn, and also the amount of risk that exists within the economy now and over time, right? Those are kind of the two major things. So if there's a lot of risk, if everything else is constant and they expect a lot of risk in the economy, then stock prices will go down because no matter how much money companies make, higher risk tends to drop stock prices. But also with corporate earnings, if they expect companies are going to hum along and do extremely well, then stock prices will go up, assuming the risk is the same, right? So one of the challenges you have right now is you kind of have a couple of variables kind of at play that are making things a little bit complicated when it comes to analyzing what's expected in the market in 2022 and beyond. First off, you have the fact that the Fed has decided that because inflation is high and because economic activity is strong, they can taper, they can stop buying back bonds, they can slow down their support for the market, and they can increase interest rates. They're saying this because they believe everything's okay. We just got to rein in inflation. The uncertainty comes in because you know that once the Fed starts to increase interest rates, that's going to have an impact on corporate investment and it's going to have an impact on economic activity. So it's going to impact earnings for some of these companies, and nobody knows exactly how much that's going to occur. And then you also have this weird state that we're in where you've got these variants that are coming out, like rap albums. About once a month, a new variant is coming out, and you don't know what's going to happen if there's another variant that comes out that has a really high mortality rate and causes everything to shut down again, which will cause the Fed to have to shift its behavior once again. So you have a lot of uncertainty there that's really hard to measure. So one way to deal with uncertainty or risk, if it bothers you, is to understand the ultimate antidote, the ultimate vaccine, if you will, for risk is time. Right? Time smoothing, where basically if you are an investor who says, I don't really care what happens between now and the year 2026, I'm going to hold all my stocks right now for the next 5 years, then a lot of these short-term fluctuations don't really matter for you. They don't really matter a whole lot. So if you say, look, I'm going to invest $50 a week in a metaverse ETF, and I'm going to do it consistently because I believe one day the metaverse is going to be huge, you're probably going to do okay because we can predict with reasonable certainty that the metaverse is going to do pretty well. What we cannot predict very well is how the metaverse ETF is going to do next week. We can't predict very well what these variants are going to look like, 2 months from now, or how, whether or not there's going to be an economic problem that comes from another direction, maybe in the next year, right? So ultimately, I would encourage you, if risk is something that you don't really like and you want to get rid of it and you want to eliminate it completely, time is the ultimate dampener of all risk factors. Think of it like water that you pour on a fire, right? Time is like the water. So if you give it enough time, all the risk kind of goes away for the most part. And now you're looking at the world as a long-term investor. And so let me just show you guys actually graphically just kind of what that looks like. So remember, I told you guys, we don't know what's going to happen in the market, right? Like this week or tomorrow or whatever. But let's say that let's say you did this 5 years ago. And if you look at the Dow Jones Industrial Average, you go back 5 years. What's 5 years ago? 2016. Well, the Dow was at 19,762. So if you were consistently investing in, say, an S&P 500 Spider or some other ETF, one of you submitted a question about an ETF called XLY, which I think is a consumer discretionary ETF kind of thing. If you'd invested in something like XLY and you did it consistently over 5 years, it would be a hell of an investment. And it would actually be better than almost any type of real estate you could buy or anything, right? Like if you buy a house and your house, your house goes from, let's say you buy a house for 150 and you sell it, 10 years later for 250 or for 300, you're pretty proud. You're like, look at that, my house value doubled in 10 years or whatever. Well, a lot of these stocks are tripling and quadrupling. A lot of these funds, if you give it 5 years, if you're able to sit there for 5 years or 10 years, you're talking about triple, quadruple, quintupling the investment. So it's far bigger than a house. And so what I'm really trying to get you to appreciate and understand is that when you're talking about that long-term wealth building process, that consistency pays, but also it's not just consistency. It's about believing in investing enough that you make that a tip-top priority for your money every month, right? So there's a difference between, give me 1 second, guys. Hold on. There's somebody at the door. Give me a second. Hold on, guys. I'm coming back. Okay, sorry about that. As I told you guys, we're in Mexico, and sometimes the maids come knock at the door. But here's the thing, right? If you think about it, if you took your investing as seriously as you take your car note, right? If we have a car note and it's $400 a month, we pay that consistently no matter what. If you're putting that $400 a month, if 5 years ago you had just put $400 a month into an S&P 500 spider fund, you would have a net worth that would exceed probably 70-80% of all Americans. So the amount of money that you probably spend on your car note, spend on your rent, spend going out to eat or whatever, if that same amount of money had been put consistently in the market just over the last 5 years, 2016 wasn't that long ago, you would be wealthy. Like, you'd be considered to be somewhat rich because you'd have, $20, $30, $40,000 in your investment account right now, right? So keep that in mind when it comes to investing. Make that a serious part of your life and teach that to your kids. All right, so let's see here. Renee is asking, what is the difference between exercising a naked call before the expiration date and after the expiration date? It's a big difference. So if you talk about a naked call, and let's say you own the call, well, remember, if you buy the call, it could be naked and it's not a big deal. Now, if you sell the call and you sell a naked call, that's a problem, because selling a naked call, just to make a long story short, kind of means you're selling the call. You're selling somebody the right to buy the stock from you, but you don't even own the stock, right? So if I sell somebody land and I don't even own the land, that's a very risky venture for me, right? Because maybe I can't even take possession of the land, and then I owe this person this land. That's a problem. You probably shouldn't do that. But the thing about it is that if you sell the call, you're not the one exercising. The person that exercises the option is the person that owns it. So the terminology, is we got to kind of flip the terminology a little bit. But if you talk about exercising the call period, which means that you purchase the call option, you do not exercise a call option before the expiration date. I won't go into the reasons why, but for various mathematical reasons, it's not efficient on any level to exercise a call option before the expiration date. Maybe if the price is super high relative to the strike price, it could make sense. But for the most part, it doesn't. In most of those cases, you would just sell the call option itself, sell it on the open market, get your money. And then if you want to go own the stock, you can still do that. So it doesn't matter. Now, after the expiration date, then yeah, when the expiration comes, like I sell call options all the time. If the price goes past the strike, then they always exercise it. I've never had a time where the price wasn't above the strike and they didn't come and actually get the shares from me. And just so you know, selling call options is a decent way to make extra income. If you can stomach a little bit of volatility, some of the premiums are pretty high. What's been happening this past couple of years is one secret way to make a lot of money. I've made a lot of money this way. A lot of people don't know about this, is that there's been a huge demand for out-of-the-money call options. Robinhood is responsible for this. Warren Buffett has always said that wealth is a transfer from impatient people to patient people. It's a transfer from uninformed people to informed people. And so what's been happening, and this is one of the reasons why, if you ask me, some people think I'm just a jerk for doing this, but I have certain value systems about certain things. Like I always tell people, be careful about drugs and alcohol and gambling and all that. And one of the reasons I have an issue with that is because, and I promise you I'm going to answer the question, so forgive me for adding a little bit extra here, but I have an issue with that because in my life, what I have seen is that people that are not rational in their thinking get taken advantage of by rational people. So, so if I'm always high, always drunk, then you're going to take advantage of me, right? You're going to say, here, sign this contract. And I'll be like, okay, here, I'll sign it, right? Because I'm high, I'm out of my mind. Or if I'm a drug addict, then all I'm thinking about is getting the drugs and I'm going to get exploited. In fact, there was actually a story about a millionaire who got drunk in a casino and he gambled away like $30 million. He gambled away like over half of his net worth. And he said, you shouldn't have done that. You should have done that to me. You knew I was vulnerable. Well, some people will say, well, it's not their responsibility to tell you not to drink so much. They just did what you asked them to do, right? So why do I bring that up? Well, because one of the things that's been pushed very heavily in the market is a lot of gambling in the markets, right? Robinhood has been accused of gamifying investing, like making it like a game, like a video game, right? Like fun, like playing Xbox or something. And it's drawing in a lot of young people who maybe would have been gambling on sports, but now they're gambling on stocks. And the best way they gamble is through call options. Now, if you don't know how options work and what options are, by the way, I have a whole stock options masterclass. If you want to go learn this stuff, you can go to, I think it's stockoptionsmasterclass.com. So feel free to go to stockoptionsmasterclass.com if you want to learn more. But options can be a very powerful tool in that it allows you to get in the game cheap, right? So if a stock is $200, sometimes you can buy an option on the stock for maybe $20, right? So, so you throw a little money at it. And the thing is, if the stock goes up, boom, you can make a ton of money really fast. But the problem is that it becomes a little bit of fool's gold because most seasoned experts will tell you that buying call options, particularly out of the money call options, is a long-term losing strategy, right? But it feels good, especially in this economy, because the market has been just humming along like speed racer. It's been flying down the road like a Corvette going 200 miles an hour. So a lot of young people are buying these out of the money call options because they feel like it's just like a quick casino, quick fix, easy money, right? So when the market slows down, which it's supposed to do in 2022, a lot of these young people are going to start getting their butts kicked financially, and they're going to learn over time, just sort of what the market dynamics really look like. But what's been occurring in the past couple of years is that people like me have seen the trend. And I've just kind of been like, yeah, well, these call options are very expensive. I don't know why you're buying them, but that's fine. So what I've done is taken the other side of the deal. Every time there's an option that's bought, somebody has to sell that option. So I'll buy 100 shares of a stock, like I bought 100 shares of Tesla, and I would just sell the options on the Tesla. So if you buy 100 shares of Tesla, now it's not cheap, but 100 shares of Tesla, so you can do it with cheaper stocks, so you don't have to just do it with Tesla. But 100 shares of Tesla costs about $100,000. But on that $100,000 investment, there are people that might make $2,500 a week off that $100,000 investment. Now think about that. If you go buy property and you pay $100,000 for a property unit, what are the odds that you're going to be able to make $2,500 a week off that unit, which is $10,000 a month? $10,000 a month. You can't go buy a house for $100,000 and rent it out for $10,000 a month. Maybe you can rent it out for $700 a month, $1,000 a month. You can't rent it out for $10,000 a month, right? So call options are a great source of income for the people that are on the sell side. It's a wealth loss for the people that are on the buy side. Okay. So and by the way, so again, if you want to learn more about options, which I encourage you to do, go to stockoptionsmasterclass.com. I did a whole masterclass, a whole weekend intensive, and broke it all down and did all of that. I'm going to do another one maybe in the summertime or something like that. Right now, there's so many other projects we're trying to finish, so I don't have time to do one now. But I will do one maybe sometime, maybe toward the end of the summer or something like that. All right, so let me keep going. Let me answer more of your questions here. Next question. What are your thoughts on NEO stock? Asked Michael Watkins. Okay, Michael's my cousin. Apparently, he's not really my cousin, but we'll just pretend like we're cousins because we're in class together, and I appreciate you. Michael's asking about NEO stock. Okay, so NEO stock is a, if I'm not mistaken, aren't they electric vehicle, and they're out of China? They're kind of like competing with Tesla in China. I got to double check that, but I believe that they are. And so here's the pros and the cons of NEO. The pros of NEO is that electric vehicles are going to be a great industry no matter what. We know they're going to take off. We don't know who the winners are going to be, but electric vehicles are coming. They're going to be here to stay. That's a point for NEO. Another point for NEO is that NEO is significantly underpriced, largely because the Chinese government is insane. They have literally done so many different things that are incredibly harmful to the economic system that it defies logic. Nobody understands what China is doing right now or why Xi Jinping keeps on destroying trillion-dollar industries with the stroke of a pen. So this could happen to NEO if they ever lose favor with the Chinese government. They are constantly checking their billionaires They got into a public fight with Jack Ma. There's some celebrity that got accused of tax evasion. They fined her $100 million. So some are wondering if at some point the Chinese people are going to revolt against what appears to be, some kind of oppression that's kind of happening here. And so it's kind of like unstoppable force meets immovable object. The Communist Party is the immovable object. Capitalism in China is the unstoppable force. So China looks at the United States and they say the U.S. is pathetic. Look, they can't. They keep fighting. Their leaders can't agree on anything. Their tech billionaires are running the country more than the president. Literally, the idea that Twitter had enough power that they could ban the president of the United States from their platform was pretty concerning for world leaders who said no tech company should have more power than the president. But that's exactly what you have in the U.S. So to avoid that, China has been cracking the whip and putting the pimp hand. The pimp hand is strong in China right now, where they are just slapping these companies with big fines, blocking their listings in other countries, punishing them in public, destroying entire industries. Also, they can show force and show power. So that's one of the reasons why, even though I like NEO as a stock, so that's my short answer. I would like NEO is a company I would invest in. I do have some money in NEO, but I do not have a lot of money in NEO or other Chinese stocks relative to the size of my portfolio, largely because I feel like the Chinese government just creates an unmanageable risk factor that is hard to sort of understand through these quantitative models that we use to value stock. You can't mathematically model the risk of the Chinese government coming in and messing everything up. So in a way, it's like, maybe you're a teenager and you meet a really beautiful girl that you want to date, but you find out that she lives on another block, where you live on the block where the Crips live, and she's on the block where the Bloods live, and also she's got a crazy mama who might come in and do something terrible, or whatever, while you're kissing her and hit you upside the head with a broom, and her daddy's, in a nutcase or whatever, right? So that's what it is. It's this beautiful asset that has all these crazy risk factors. Kathy Wood likes NEO, and I do like NEO a little bit, but I don't like China as an investment strategy, so I would be extremely careful. So I hope that answers your question. And again, if anybody has any other questions about any other stocks that you're interested in, or any sectors you're thinking about invested in, or any financial questions in general, just log in at theblackstockmarketprogram.com and put your question in. I will answer your question first. Okay, so let's keep going. Okay, so let's see. Maurice is asking about 3 separate stocks, and